Hello everyone. Today we will start a new topic which is monetary policy. So welcome you all. Let's start. So first we understand what is monetary policy. So the cost on which we get the fund from RBI and the availability of money, or in economic term we call credit. So cost means the interest rate on which RBI puts interest rate, more specifically repo rate. So monetary policy. So we study monetary policy to control money supply in the market. When RBI when RBI provide when RBI provide funds to the bank with lower interest rate, it increases the money supply in the market. So monetary policy worked under monetary policy work under monetary policy committee. Monetary policy committee, which is called MPC. MPC functions after 2016. So monetary policy committee, the MPC is chaired by governor. Is the chairperson of MPC, and there are 6 members. Three from RBI and three from government side, means government of India. So MPC regulate inflation, which should be under 2 to 6% per annum. This is the inflation target of the year. Two type of monetary policy. So first one is expansionary monetary policy, which is also called cheap money policy or easy monetary policy. So when RBI try to make credit cheaper for public, so when RBI, which is MPC, try to make credit cheaper, try to make credit cheaper, they lower the interest rate. When there is a lower interest rate, there is more demand for loan. More demand for loan by public. So higher money supply. So it leads to higher consumption and investment expenditure. It's led to higher inflation, and higher growth. One is contractionary monetary policy, which is called tight monetary policy, tight money supply, dear money supply. MPC make credit costlier, which means increases the interest rate. When RBI increases the interest rate, then there is a lower demand. When they when RBI increases the interest rate, there is lower demand for loan by public. So there is lower money supply. There is lower money supply. When there is a lower money supply, then there is lower inflation and lower growth. So there is two type of monetary policy. First one is expansionary monetary policy, in which RBI make the credit cheaper for the publics. So there is higher money supply in the market. So there is a higher money supply in the market, due to which higher inflation and higher growth in the market. In contractionary monetary policy, RBI make credit costlier for the publics, which led to lower demand by the public for loan, which led to lower money supply in the market. Instrument of monetary policy. So there are two type of instrument. First, quantitative. Second is qualitative. So let's first understand quantitative. So the first is cash reserve ratio, CRR, cash reserve ratio. So minimum proportion of NDTL. NDTL means net demand and time liabilities. Minimum portion of NDTL that a bank must statutorily required to keep with RBI. Required to keep with RBI. Okay, in the form of cash. In the form of cash. Increases CRR. It means increased reserve deposit ratio, which leads to less fund available with bank to provide loans, which means bank puts higher interest rate on that loan, which leads to less demand by the public for loan, which leads to lower money supply in the market. SLR, statutory statutory liquidity ratio. Statutory liquidity ratio, इसमें क्या है कि जो मिनिमम प्रोपोर्शन ऑफ NDTL should keep with bank themselves. Should keep with bank themselves in the form of government security, reserve, deposit with other bank, gold. In SLR the bank required to keep their reserve with themselves only. So 18% of NDTL is statutory required to keep with themselves. Let's understand how SLR control money supply in the market. So higher SLR, higher reserve, less fund with bank to provide loan, which means bank put higher interest rate on that fund, which leads to less demand by the public for loan, which lead to lower money supply in the market. Repo rate. Third is repo rate. When RBI increases repo rate, It's make the fund costlier. Fund costlier. Then there is less demand by public, which lead to lower money supply in the market. 3. So there are three type of facility provided by RBI to commercial bank. So the first one is liquidity adjustment facility, in which RBI provide a facility to bank to manage their short term liquidity mismatch. Short term liquidity mismatch through repo and reverse repo. Manage their short term liquidity mismatch through repo and reverse repo. So the second one is marginal standing facility, in which RBI provide overnight loans to bank, so third one is standing deposit facility, in which RBI allow bank to provide in which RBI allow bank to keep surplus fund with RBI and earn some interest rate without need to some interest rate without need to buy government security. Open market operation. In open market operation, either RBI can buy government security from the bank, or RBI can sell government security to the bank. So first one is either RBI buy government security from bank, or or RBI can sell government security to bank. So these are these are expansionary monetary policy, or these are contractionary monetary policy. So in open market operation, there is no need to repurchase the government security from the RBI. So so there is no there is no repurchase obligatory. So there is no repurchase obligation for the bank. So let's first understand expansionary monetary policy, which is when RBI buys government security from bank. When RBI buy government security from bank, which means which means more fund credit in the market, which means more liquidity with bank. So liquidity with bank, it means lower interest rate. It means lower interest rate. When there is lower interest rate, there is higher demand for loan. Higher demand for loan by public. Then is a which led to higher money supply. And the second one is when RBI sell government security to the bank. So this is the contractionary monetary policy. When RBI can sell government security to the bank, which means contractionary monetary policy. So less liquidity with bank. Less liquidity with bank, which led to higher interest rate. Which led to higher interest rate. So lower demand for loan by the public, which led to lower money supply. Study qualitative instrument. Instrument So first one is moral suasion. In moral suasion, there is a informal instruction. Information there is informal instructions to the public's bank through a public forum like universities, interviews, podcast, etc. Through interview, podcast, university, about changing behavior of changing behavior of economy. Monetary policy targeting, which is MPT, whether monetary policy impact have reached to the people or not. If the monetary policy impact reach to the public, it means good monetary policy targeting. If not, it means bad monetary policy targeting. जो monetary policy का impact है वो पब्लिक के पास पहुंच रहा है कि नहीं. यदि पब्लिक के पास पहुंच रहा है तो वह गुड एमपीटी है. यदि नहीं पहुंच रहा है तो वह बैड एमपीटी है. When RBI lower the repo rate, the bank should also lower the lower the interest rate by similar degree. Lower the interest rate by similar degree to the public. If this happen, it means good MPT. If 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 this is not done, it means bad MPT. When RBI lower the repo rate, but bank does not lower the repo rates. So when RBI lower the repo rate, but bank does not lower their interest rate or lending rate, it means bad monetary policy targeting. Generally, contractionary monetary policy often will transmit it to the public. Generally, contractionary monetary policy will transmit it to the public, but expansionary monetary policy there is challenges. So contractionary monetary policy well transmitted to the public. Expansionary monetary policy there is challenges. There is challenges because it reduced bank profit. From to control monetary policy targeting. So the first one is benchmark prime lending rate, which come in 2004, which is called BPLR. In 2010. Third one is MCLR 2016, which is marginal cost of fund based lending rate. Fourth one is EBR, external benchmark rate 2019, in which in which bank in which bank have to link their lending rate with any one of the three. First, repo rate. Second, 3-month treasury bill. Third is 6-month T bill.